We have the past picks of David Burrows. He's the president and chief investment strategist at Barometer Capital Management. July 11th of last year, you recommended United Healthcare, UNH. You're up a solid 28% here. You're still liking the story?
Yeah, we're big believers that Obamacare is not likely to cut costs so dramatically. It's going to increase the opportunity for revenues for the whole industry. United Healthcare just beat their estimate. They raised their guidance going forward. They talked about entering 24 new state exchanges over the next year. So these companies have an increasing opportunity to build the business. And healthcare is one that has been a leading sector over the last year. So we would tend right now to focus a little more on biotech than drug and managed care, but the whole sector has been performing well.
Speaking of biotech, just a quick answer. Janet Yellen, the Fed chair, made those comments recently about the valuations being stretched. What did you think of that?
I think that what's happened is that in biotech, the ETF is the most actively traded ETF.
The IBB.
Right. And so that includes the big caps like Gilead and Biogen and Vertex, but it also includes all the little ones. And so the big ones are growing twice as fast as the pharmaceutical industry. They are not overvalued, but there's some little ones that trade at extreme valuations.
Next up here is Ford Motor out with earnings today. You recommended this last July. You're up 8%. I'm guessing you might have liked a little bit more than that, but tell us what you think of Ford now.
Well, so we over the course of the year have rotated from the big manufacturers to the parts companies. So we've talked about Magna on this show. We've talked about Linamar. We've talked about Lear Corporation. They are behaving a little bit better. Ford came with great numbers today. You know, I think that the fact that they've turned around Europe, I think is a big deal. They're making better headway in China than they had been. They were a little behind GM there. So I think that this is a great business. They're going to get 8 to 9% margins on the year, which is quite attractive. Stock's making a new high. I don't have no problem owning the stock, but we prefer the parts companies like Magna.
You also recommended Amazon.com, trading at 300. I'm sure at the time I said, what about the valuation, David? And it hasn't mattered. You're up 20% since then. Tell us about your feelings on Amazon now.
There just continues to be secular growth in online retailing. Amazon is the elephant in the room. Over time, they've invested enormous capital to put themselves in this position. Over time, their margins are going to improve. Over time, the revenues are going to keep growing. You know, I think that they probably will have 25% year-over-year revenue growth. For such a giant company, I think that that's spectacular. They've got their new phone. I think that that's attractive. Consumer discretionary has underperformed over the last couple of months. It seems to be coming around here. So, you know, this is one that you could own as a proxy on internet retail.
The phone and the Kindle, those are really meant as just sort of
they're just aimed to drive traffic to their warehouse.
The Prime service, $80 a year, whatever it is, $100 a year. So are they decent vehicles? Is the hardware any good? Or?
Well, I think that the reviews so far have been that it's an okay phone for somebody who's looking for something relatively ubiquitous. I think that the features were not spectacular. I don't think it's probably going to stack up to an iPhone 6. But all of these things are just helping them to build critical mass and a defendable business model, and I think that it's going to be very hard for people to overcome that.
Back to Ford for a second. You expect people in the U.S. to continue to buy new vehicles?
Well, when you look at the fact that consumers have more free cash flow today than they have had in over 10 years, because debt servicing costs have come down, and because inflation in commodities and food has come down, consumer free cash flow is actually growing faster than the trajectory in new cars. So the average age of the U.S. fleet is about 11 years old. We think that still there is catch-up to be done there. Certainly financing is readily available. And as Europe improves, that should add to the opportunity.
Just to recap, past picks from David Burrows, Amazon.com, Ford Motor, and United Health. We'll take a short break here and come back with more questions right after this.